Global AI spending will top more than $330 billion in 2025 and $500 billion by the end of 2026. And by 2030, it could take about $2 trillion a year to support the infrastructure being built today. That's more than Amazon, Apple, Microsoft, Meta, NVIDIA, and Google's parent company Alphabet made combined in revenue in 2024.
It's the start of trillions being spent in this build-out of the fourth industrial revolution. Big tech right now is doing the equivalent of building Vegas in the 1950s, where there was just sand. Dubai 30 years ago. That's what's happening with this AI infrastructure build-out. From the chips to the data centers to the grid, you're really building out the future economy for consumers and enterprises.
But some investors are worried where this is headed.
The concerns about AI spending here harken back to the dot-com bubble in the late 90s. The parallel is that it's money going into somewhat unproven technology and wondering if you end up with just wasted money.
At the same time, this explosion of AI spending may be masking other weaknesses in the economy. A September 2025 Deutsche Bank analysis argued that without AI-driven investment, the U.S. might already be in a recession.
GDP is being driven by all this investment. Earnings growth is being driven by all this investment. Yeah, it's pretty unbalanced right now, and that does create a vulnerability to an investment bust.
Still, others see AI as the next productivity boom and potentially America's best shot at growth.
Will there be bumps along the road? Yeah, but I don't fear that this is too big to fail, given it's propped up by tech, trillion on the balance sheet, generating another 300 to 400 billion in cash a year.
So is AI infrastructure spending masking a weak economy? And what happens if that spending slows? AI spending is powering corporate growth, stock market gains, and parts of the GDP. The biggest names in tech are riding a wave of AI-driven optimism.
There's going to be more spent in the next 2 years than the last 10 years combined in tech. 2 to 3 trillion. You're only in the second inning of a 9-inning game.
Unlike the dot-com boom, where companies had little revenue, many of today's AI giants are bringing in a lot of cash. But some experts are worried it may not be enough to sustain the elevated level of spending. Some companies are turning to the bond market to finance the infrastructure expansion by issuing debt that they plan to pay back later. That means if profits fall or the technology doesn't deliver, companies could be left with loans they can't repay. The consequences wouldn't just hit the stock market, they could also hit the overall economy.
Consumer spending, corporate spending, it all depends on how people are feeling. If people are feeling positive about the future, if CEOs are feeling good about growth prospects, if CEOs look at business conditions, they're going to keep spending because the money's there. If interest rates stay low, they're going to keep spending because money's plentiful and it's easy to get. If any of those conditions should start to deteriorate, specifically inflation. If inflation starts to spike, it will change consumer attitudes. If the labor market gets worse, it will change consumer attitudes, it will change business attitudes. So all of these things have to kind of keep working in concert together to be able to continue this cycle or super cycle of AI spending. Should one of them fall out of place significantly, it could change the dynamics of everything and cause problems.
But not everyone sees this as fragile. Some think AI is simply the future of innovation.
The reality is it's an arms race, US versus China. And they don't have time to slow down because China is accelerating it as well. And I think that's bullish in terms of the CapEx cycle that I really view as an AI super cycle.
Experts call the spending surge we're seeing a CapEx Supercycle. This is when companies keep pouring money into building out the infrastructure for this new technology.
When we talk about super cycles, we think about an accelerated pace of something. We talk about sort of a peak, things that we have seen in the past when huge changes come about in industry.
This is the biggest tech spending trend we've seen in the last 40, 50 years. There's a view that it typically ends a CapEx cycle after 2 to 3 years. The super cycle means that this could go on not just for 2 to 3 years, 5, 7, 10 years. That's why by definition it's really an AI tech super cycle.
To sustain this level of spending, companies need a few things: favorable borrowing conditions, strong profits to self-fund expansion without relying entirely on debt, and confident investors so they can keep supporting high valuations and remain willing to fund long-term bets in the space.
But certainly as we go through the rest of these incredible estimates of how much capital is going to be required to build out this infrastructure to avoid seeing electricity prices to continue to go up for the public, is going to require a lot of debt over time. Once that cash flow has been used up, that'll be a real sign that we're getting into the more, dicey or precarious stage of that process.
If AI companies flood the market with new debt, or if interest rates stay high, investors could pull back, exposing a fragile national economy. While AI spending is booming, much of the U.S. economy isn't sharing in the gains. This spending may make the U.S. economy look healthy on the surface, but the averages may be obscuring a deeper divide.
There's this notion of a K-shaped economy that really started to take root about 5 or 6 years ago.
A K-shaped economy means that while some people, mostly investors and homeowners, are doing better than ever, others are falling behind.
One speed is people who are asset holders, like who own stocks, who own large amounts of real estate. They're doing very well. At the bottom part of that K are people who don't have exposure to those kind of things and are kind of just living paycheck to paycheck and are trying to save a little bit of money here and there, not getting very much return on the money that they do save, and therefore they fall further and further behind.
Consumer spending, which is typically the cornerstone of American economic growth, has been showing mixed signals. High-income earners are the driving force behind most retail sales, but lower-income Americans are struggling to keep up.
When the spending comes from people who are at higher income levels, it masks what the greater fundamentals are for the economy. The people who have the most money, they can weather inflation, but if your income's not going up as fast as inflation is going up, that's not a good thing, and it hurts more when you're at the bottom end of the ladder.
Some argue that AI could be exacerbating the divide by benefiting asset holders, while the bottom half of the economy sees little to no lift. The labor market is also struggling. Unemployment is low, but hiring has slowed, and long-term joblessness hit nearly 26% in August 2025.
The labor market looks very, very weak to me. It's on the precipice of a more pronounced decline.
Almost all of the growth has come from government-related sectors, things that are dependent on government spending, particularly healthcare jobs and government jobs. The other part of the growth story has been service-related jobs. The rest of the economy has not seen much growth as far as employment goes. So while it looks like a lot of people are working, and they certainly are, there again is another story of not an equal dispersion of gains, not a widespread dispersion of gains. Things just sort of concentrated. And when things are concentrated, if you have weakness in a particular sector, that could spell trouble.
AI is already disrupting the job market. The International Monetary Fund estimates that about 60% of jobs in the developed world are exposed to AI, meaning they could be transformed or replaced by automation in the coming years.
Does it cause some pain? Yeah. Will there be job losses? Yeah, but net, I think it's a job creator when it's all said and done, and I think it's going to be a huge tailwind for the U.S. economy.
Estimates suggest that significant labor market disruption will scale gradually over the next decade as generative AI technology is adopted. During that transition, the divide between those who hold capital and those dependent on labor could widen. But to some, this is a once-in-a-generation opportunity.
I believe this AI supercycle is just starting. So I don't view that this is one propping up the economy. Is just the start because of the multiplier. Every dollar spent on a NVIDIA chip is a $10 multiplier across the rest of tech. That's also going to be bullish for infrastructure, power, grids. And that's really the future as it spreads beyond big tech.